All right. My name is Heather Liston. I am a certified financial planner and also an enrolled agent. And for those of you who don't know what that part means, an enrolled agent is a tax professional. It means that I've passed a series of exams given by the IRS. So I'm qualified not only to prepare tax returns, but also to represent clients in disputes with the IRS. And I did that mainly so that I could be a better tax planner. So, thank you all for coming. I love working with realtors, and we're going to talk today about everything related to retirement plans. But it's a pretty big field. So, again, I do want to invite you to tell me if there's something in particular on your mind. And a minute ago, I suggested you put any questions in the chat. I don't think anyone did yet. But if you want to take a minute and actually speak up, because we're not a huge crowd, you can speak up and say it out loud if there's something on your minds that you want to make sure I get to. I'm not sure if you're muted. Might want to check that. Or you might be shy or tired. Okay, so as we go along, do feel free to put things in the chat because I really would like this to be useful for you, the people who came. Okay, we're gonna jump to the next slide. Here we go. One of my favorite cartoons. If you've been to webinars I've given before for any group, you've probably seen this before. Roz Chast is one of my favorite cartoonists. She's with the New Yorker. And this is how I kind of feel about pensions. Whenever I work with a client who has a pension, I'm so impressed. And they often complain, oh, I only get X dollars a month. I say, stop it. It's great. Any pension is great. They're fairly rare for anybody to have that now, which is why we have to save our own money for retirement. I am self-employed personally, and I'm guessing some of you are also. And of course, the self-employed really have no outside help. We really have to manage this on our own. We're on our own for making sure that we can someday retire. Here's my list of the long list of topics that we will probably get to today. First, why is all this worth the trouble and complications? Why don't we just stuff some money under the mattress? Then I want to do an overview of plan types. You've probably heard of 401ks by now and IRAs, but there are lots of variations on both of those, including there's Roth IRAs and Roth 401ks. There's now even a Roth SEP IRA. That's pretty new. Small business plans, in particular, are the SEP IRA. That's been around for a long time. The solo 401k, which is a little bit newer, and for many people, even more lucrative. The simple IRA, of course, 403Bs and 457s are for nonprofit and government organizations. So lots and lots of types of plans. We're going to talk about eligibility, income limits, contribution limits, and withdrawal rules. The Savers Credit, that's a thing that's there to encourage low-income people to save for retirement. Required minimum distributions, backdoor Roths. If we have time and anybody's interested, we'll even talk about the ridiculously named mega backdoor. So as I said, I'd like to know what you want to know. I'm going to peek again at the chat. Oh, you're still shy. Nothing in the chat. Okay, so I'll keep going, but you tell me if you want me to stop. So why do we even have retirement plans? Again, why not just stuff money under the mattress? This is one of my favorite political comments. Senator Paul Wellstone of Minnesota once said, we all do better when we all do better. I usually get a little choked up when I say that because ideally that's the underlying idea behind almost all laws. Um, in other words, nobody's better off if people are starving, if people can't ever retire and have to work till they die. Nobody's better off if your grandparents can't afford to pay their bills or you can't get the health care you need in retirement. And because of that, our government has put in place various types of retirement plans that give you tax breaks, that encourage you to save for retirement. Because it's good for everybody. If we save for retirement, we can take care of ourselves, we can contribute to the economy. So think of it as not only taking care of yourself, but helping take care of everybody when you proactively make sure that you're putting away money for retirement. What makes official retirement plans worth the trouble? I mean, if you looked at my list of topics today, you may already have thought, oh my goodness, that's kind of overwhelming. What did it list like 9 or 10 different types of plans, yada, yada, rules and regulations? Why is it worth the trouble? Number one reason is tax advantages. Some types of plans we save taxes right now, which is great. Some types we save taxes later in the long run, which is also great. So tax advantage is the number one reason it's good to know about these retirement plans. The second reason is systematic savings. When we have a retirement plan, we don't have to think about saving as much. We can get it set up automatically often. We don't forget to save. And we are often able to avoid the temptation to do market timing, which never works very well. Market timing, for those of you who don't do a lot of investing or aren't familiar with the jargon, market timing means trying to guess what's the best day to invest. And by the way, everyone guesses wrong. It's human nature to guess wrong. Um, for example, on a day when the stock market is very high, when things are trading at a high volume and a high amount, and Tesla prices are up and Apple prices are up, we all feel good about the economy and we think, oh, I want to get in on the stock market. When things have crashed, somebody's made a dumb announcement and stock prices plummet, that's when we all feel like, ooh, I don't know about stocks. Maybe I'll just put my money in bonds or something. That's the best time to buy. So our emotions tend to work against us when it comes to investing. We all have heard you're supposed to buy low and sell high. Our emotions say no, buy high. So systematic savings through a retirement plan can get all that dumb emotion out of the way. And by the way, it's not just you or just me. Professional investors also who do this all day long, they don't do so well when they try to guess the market timing either. So if you have a 401k plan or a 403b plan, you're having a little money withheld from every single paycheck and you're investing in stocks on a regular basis, every week, every 2 weeks, twice a month, however often you get paid. So it takes that emotion out of it and it takes the poor market timing out of it. So those are great reasons for dealing with a retirement plan, the tax advantages and the systematic savings. Here's some rules of the universe, because basically the principles are all pretty simple. Number one, it's always good to reduce your taxes. Number two, when you have money withheld from your paycheck, you don't miss it as much as you think you will. In other words, you tend to think about, we all feel, what's our take home pay, right? You may be told, oh, your bi-monthly check is $3,000, but what really goes in your bank account may be 1950 or something like that. So if you have a little more withheld from your for your retirement plan, you're not going to miss it as much as you think you will, partly because if it's a tax deferred plan, then you're going to have less tax withheld when you have something withheld for your retirement plan. So in other words, let's say you decide to put $100 a month into your pre-tax 401k. Fine, you have $100 a month withheld from your paycheck, but because you're not paying tax right now on that money, your paycheck is not going to go down by $100. It may go down by $70 or something like that, but not as much as the full amount, which is great. Number three, with tax deferred payroll withholding, your savings account is going to grow faster than you expect. I promise you that. People are often amazed how much money is in their retirement plan as long as they get started. Now, we do have to pay some taxes, and that's okay. We want to live in a civil society. But if you have to pay tax, one rule of the universe is that paying later is usually better than paying sooner. Putting it off is a great idea. That's what tax deferred means. It means paying later than paying now. And now, if you're working, you're probably earning good money. You're in a relatively high tax bracket. Maybe in the future, you're going to be retired. You're going to have less income. So paying more later when you're in a lower tax bracket is good, moving some of your income to later. Reasons to participate: tax deferred contributions, tax deferred or tax free savings and growth. Tax free is amazing. And basically, tax free is a synonym for what we in the business call Roth accounts. Roth accounts, you get no tax break now, but it grows tax free for the rest of your life and 10 years beyond the rest of your life. So, Roth accounts are fantastic. Other reasons to participate: automatic savings, no need to think. I love when things are simple. And I say that even as a professional. I mean, you have other things on your mind. You're out there trying to sell houses or whatever else you do. I work with retirement plans and financial planning all day long, and I don't even want to think more than I have to. Everything that's automatic and simple is usually the best way to do it. Other reasons to participate: I want you to retire someday. And finally, if you have a job where you work for someone else, your compensation includes the right to participate in a retirement plan. The company put that in place to help attract you, to help retain you, and to help compensate you. So don't miss out. It's very valuable. Reasons not to participate: And by the way, this is a picture of some workmen near my house. I really admire people who do manual labor, and partly because I can't do it myself, partly because I don't want to do it myself. So, as much as I admire these hardworking men, I don't want them to have to do that forever. So, reasons not to participate. Why would you not participate in a retirement plan? Maybe you enjoy paying as much tax as possible. Maybe you're so rich you can't imagine what you would do if you had more money. Or maybe you love your job so much you never have to retire. You hope you never have to retire. Honestly, these are really the only reasons not to participate. I know another one that comes to some people's minds is they say, "Oh, I can't afford it." And I'm sorry, I do understand how hard it is when you're not earning quite enough yet. But honestly, that's not really a good answer. If you're not earning enough to save for retirement, then you're not earning enough because we really do need to think of our future self and take care of her as well. So these are all somewhat facetious, and I hope they make the point that we really all need to be saving for retirement. No matter if we're young or we're old or we're high earners or low earners, we kind of all need to. So those were facetious reasons. Here's some real reasons that I hear. And in a previous iteration, I was an HR director. So I was often trying to nudge people to sign up for the, in that case, 403B plan. By the way, a 403B is almost exactly like a 401k now. So if I say 401k and you have a 403B, don't worry, basically the same thing. So real reasons why people didn't participate, they'd say, "Oh, I got to check with my wife. She does the money." So don't worry about that. You're just as smart as they are, and it's not as complicated as it seems. A really important reason that people didn't sign up right away is they would say, "Oh, I don't know what funds to invest in. Let me think about it and I'll get back to you." Not a good reason to wait. It's better to do something than to do nothing. In other words, if you're thinking about signing up for your 401k plan, something that deters some people is you'll get all through the process of getting signed up, and then you'll see Fidelity or Betterment or wherever the plan is, or Empower or Schwab. Sometimes they'll give you a list of 20 or 30 funds to invest in. Sometimes people feel lost. That's okay. Don't worry about it. What you do is you get started anyway, and then you can always change it later. You can change your funds anytime with a retirement plan. So don't let that slow you down. And by the way, this probably comes up later in my presentation, but if you don't know what to invest in your retirement plan, that has gotten easier than it used to be. There are now these things called target date funds, or what else do they call them? Retirement date funds, or something like that. Fidelity Freedom Funds. Basically, what they are is the institution will make a mix of stock and bond funds for you, and they will gradually change it as you get older. So you don't have to think much at all. You don't have to pick a combination of funds. You can just say, put all your money in the target date fund for 2050 or 2040. And what that means is you think, I'm going to retire approximately in 2040. It doesn't matter. It's not really a big deal. You don't have to choose the right date. Just choose one of them, and that way you don't have to think too much. We don't want to think too much. We have other things to think about. So don't let the question of which funds to invest in slow you down. Go ahead and get it done. You can always change it later. Sometimes people think there's more important, more interesting things to do today. Nope, this is super interesting. This is about your long-term comfort and health. And again, I'm being a little facetious. I find it super interesting. If you don't find it super interesting, you can find someone who can help you. If you're working for a regular company, where you have a job and someone else designs your retirement plan, ask them for help. If you're doing it independently because you're self-employed, you can still ask someone for help. You can contact a place like Fidelity or Vanguard and say, "Hey, I need to set up a self-employed retirement plan. Can you help me?" And they will say yes. So don't worry about it too much. Yes, it can be somewhat complicated, but we will focus on the important steps. You'll notice in my original, my sort of table of contents at the beginning, I named a few things that sound confusing, and they are, like the backdoor Roth and the mega backdoor. Those are kind of confusing, but those are advanced tricks, and you don't have to do that. We're going to focus on the basic, easy steps first, and you don't have to do anything tricky unless you really want to. So again, why do we do it? Number one, I think I put these in the opposite order a few minutes ago, but they're both super important. Number one is systematic savings. Number two is tax shelters. And basically, both of those add up to we do this so we can retire someday and stop working so hard. I see that a few more people have arrived recently. So welcome. And I just want to mention at any point, put questions in the chat. I very much want this to work for you. So I'm happy to entertain your specific questions if you want. Key concept. There are basically two sort of overarching types of retirement plans. There's the tax-free and the tax-deferred. Tax-free, as I said, is often called a Roth account. By the way, that's named after a senator named William Roth. I think he died a few years ago, but he came up with the idea of what we now call the Roth account in around 1998. And that's like a whole new type. Well, it was new then. I realize some of you probably weren't born in 1998. But it added a whole new dimension to retirement plans. In a way, it made things a little more complicated, but I don't want that to slow you down. Both of these types are good, tax-free and tax-deferred. And anytime a decision like that slows you down, first of all, I'd say don't worry because they're both good. And second, you can always do a little of each. People who've been to my investment seminars know I always talk about ice cream because my father loved ice cream, and his answer, if you said, "Do you want some of this or some of that? Do you want the Rocky Road or the Bubblegum Crunch?" He would always say, "I'll have a little of both." So he passed away a few years ago on his birthday every year. My siblings and all, wherever we are in different cities, we go out for ice cream, and the only rule is you have to get more than one flavor. So feel the same way about investing. If you can't decide, get a little of each. They're all good. So tax deferred accounts we often refer to as traditional, and tax-free accounts we often refer to as Roth. So if someone says, "Do you have a traditional IRA?" That means you put in the money, you got a tax deferral now. And I do find clients are sometimes confused about this, and they'll say, "Oh, yeah, I have a traditional Roth." Nope, I need to know it's either traditional or it's Roth. Kind of obvious why traditional existed before what we now call Roth. By the way, most traditional accounts, and that's pre-tax IRAs and pre-tax 401ks, they were basically invented by what we call ERISA. That's an acronym, ERISA, not even sure if I get it right, Employee Retirement Investment Security Act, I think, of 1978. So it was in 1978 that a lot of these retirement plans, tax advantaged retirement plans, became legal and started being really regulated. So ERISA of 1978 was a really important new law at the time, and it was made in recognition of the fact that more and more people didn't have pensions, and we were going to have to look out for ourselves. So traditional plans are pre-tax or tax deferred. Roth accounts are tax free. Now, what that means is, to go back for a second, what that means when I say tax free is when you put money in a Roth account, you do not get a tax break right now. Doesn't change anything right now. But the long-term effects are fantastic. The long-term effects after you've put money in the Roth is that it will never be taxed again. So any interest you earn, any dividends you earn, any capital gains, any growth, never taxed again. So Roths are particularly great if you're young and there's like an infinite amount of time. If your money's going to grow for 50 years, you are going to make out like a bandit with a Roth account. Or if you are in a relatively low tax bracket right now, maybe you really don't need the tax break right now. Maybe your top tax rate is 12 to 15% or even 22%. I'd put your money in a Roth because then the earnings will never be taxed. Now, if you are in a very high tax bracket, maybe you earn more than 200,000 a year, say, and your marginal tax bracket is 37%, then I would probably push you to put most of your money in a tax deferred account because I want you to lower your taxes right now. But if you're not sure which one, don't let it slow you down. Remember, they're both great. So I don't want this decision to be any reason not to go ahead and get started. They're both great. So here's an example of how it might work if you put money in a traditional IRA or a traditional tax deferred 401k. Let's say you have $200 withheld from each paycheck. You put it into your pre-tax 401k. Your take-home pay from each check is not going to be reduced by $200. The reason is that when we take that money out to put in the 401k, we also are lowering your taxes right now. So you don't have to have as much withheld for taxes, which is great. So both your federal and state tax are reduced. I'm a Californian, although I mentioned I'm in Chicago right now, but I live in San Francisco. And I believe you're all in Orange County, California, or thereabouts. So you know that not only do we have federal taxes to pay, we all have probably significant California taxes. And by the way, federal tax rates right now are between 10% and 37%. You're probably, I don't know if you earn a little or a lot, but the middle range there is 22, 25%. But state taxes for California, the rates range from 1% up to about 13%, but there's an enormous bracket in the middle. For most of us, we pay California state taxes at the 9.3% rate. For some reason, California has one very wide bracket. So you're very likely in the 9.3% California bracket, regardless of what your federal bracket is. So just keep that in mind. And California conforms to federal law when it comes to plans like this, meaning that if it's tax deferred for federal purposes, it's also tax deferred for state purposes. So we're going to reduce your tax withholding from your paycheck so your money doesn't go down by the full amount, that your take home pay does not go down by the full amount that you put into your retirement plan, which is great. So then that money that you had withheld, that $200 that you had withheld from your paycheck, it's going to go into your 401k. You're going to invest that money in some kind of fund and you're going to watch it grow. And keep in mind also, because it's pre-tax, you've got a whole $200 in there that you're investing. Now imagine that you didn't have access to a 401k plan. Let's say, you wanted to save $200, that's great. But because that would still be taxable, maybe you'd only be able to put away $161 or $110 or something because you're paying taxes. So because this is pre-tax money, you've got more money to save, more money to grow. Then later, when you're retired, you're going to start taking the money out and paying tax on it then. And for most people, your tax rates are going to be lower when you retire. So two advantages tax-wise. One is that you're putting it off. If you're young, you may be putting off your taxes by 30 or 40 or 50 years, even if you're not young. I'm not young, but I'm still working. So I'm probably putting off the tax rate by at least 5 years, maybe 10 or 15 years. So delays are good. Remember, paying tax later is always good. And then also, quite possibly, your rates are going to be lower when you are retired because you're earning less money, maybe no money. So that was the pre-tax example. Now we go to the Roth example. Let's say you have $200 withheld from each paycheck and you put it in the Roth portion of your 401k. Your take-home pay will be reduced by $200 because you don't get a tax deduction right now. But then you invest the money in your Roth 401k, you watch it grow. Years from now, when you take it out, you pay no tax whatsoever. I don't care how much it's grown, how much interest you've earned, you pay no tax ever again. So that is fantastic. Also, another good thing about Roth accounts that I probably have on a slide, but I'm going to say it more than once. Roth accounts have no RMDs. An RMD means a required minimum distribution. With pre-tax accounts, at a certain point, when you're 72 or 73 or 75, you're going to have to start taking that money out whether you want to or not and paying tax on it. With Roth accounts, no RMDs. You can leave it in for your entire lifetime if you want. You can leave it to your children or other heirs, and they won't pay any tax whatsoever. So Roth accounts, you're in control of what you do with it over the long run. So again, they're both fantastic. Don't let the choice slow you down. Overview of plan types. Here are, as I said, I wish it weren't quite so complicated. Every one of these types of plans was the lawmakers, Senate and the House and the IRS and all the people involved in these things. Every one of these was designed to try to help people. And yet they are invented at different times, at different points. The lawmakers designing these plans, they don't always talk to each other. They don't always seriously consider how the new plan relates to old plans. So they kind of have a tendency to invent new ones when I wish they would just kind of tweak the old ones. But not my decision. So it does get a little bit complicated, but I've tried to organize them. So if you are an individual, meaning meaning these are not employer-based plans, the individual plans, the traditional IRA and the Roth IRA, those were originally invented for self-employed people. At this point, we have even better plans for small businesses and self-employed people. The three on the bottom left there, the SEP IRA, the solo 401k, and the simple IRA. Those are good business plans. But the individuals can still, if their income is excuse me, if their income is not too high, there are income limits on this. You can contribute to a traditional IRA or a Roth IRA. So those are for individuals. These are for small businesses. And when I say these, I'm pointing with an arrow. I don't know if you're seeing that. But on the right, these are employer-based plans. 401k, 403b, a 457, and a 409a. These are plans that your employer can offer if you have a regular job where you get a W-2. And the bottom three here are relatively rare. The 403b and the 457 are only available to nonprofits and government organizations. Kind of guessing that's not you, so we're not going to focus on those. The 409a is what's called a non-qualified deferred compensation plan, tends to be for high-level executives at big companies. So I'm not going to focus a lot on that either. So when I say 401k, assume that means all employer-based plans. Now, I would like to know how many of you are self-employed versus who has a job. So if you would please, would you just put in the chat if you are self-employed? That'll help guide me about what it's more important to focus on. I don't see anything yet. I hope you can see the chat on your screen and that you're not just a very shy bunch. I'm going to give you a minute. Okay. I hope the chat is available. Would somebody just send me a note in chat so that I know for sure it's working? Meanwhile, I will go on. I wanted to know who is self-employed versus who has a regular W-2 job. Just a second. And a W-2 job means you're employed by someone else. You have an employer. You know what? I asked if someone would put a note in chat just so I know it's working, and I'm not seeing anything. Elsie, if you're still there, would you make sure chat is turned on? Because these people may be very shy, but I really would like some participation if possible. Okay, so the next question I was going to ask you, if you really wanted to chit chat, is who has a SEP IRA, a solo 401k, or another type of self-employed plan? And who has a spouse with a retirement plan, because that can be important too. Marriage is very important, particularly in California. Marriage gives you certain rights and responsibilities and tax breaks that unmarried people don't get. And I want to know if you are self-employed and also have an employer, because all these things open up sort of different possibilities. We're going to start now by talking about employer plans. As I said, there's a variety of types, but by far the most common is the 401k. And particularly for you people who I don't think are in nonprofit organizations, in general, 401ks are probably what you have. Almost any kind of company can have a 401k. Almost all 401ks now have a pre-tax option and a Roth option. The Roth, again, started in 1998, but it used to be relatively rare. At this point, when it comes to 401ks, I think almost all 401ks offer both pre-tax and Roth. Now, less common is some 401ks also offer what they call after-tax contributions. That is a little bit weird because I already told you that a Roth account is after tax. So this is confusing, but there is such a thing as a third category. Some 401k plans will let you put money into your pre-tax and or your Roth section and or the after tax. The after tax is a whole different thing. That's where we get into mega backdoors, which is sort of complicated, and we won't dwell on it unless someone tells me that it's really of interest to you. It's a common thing I see in technology companies. And as I mentioned, I live in San Francisco, so I work with a lot of clients who work for, big tech companies, Google and Apple and places like that. They tend to offer the mega backdoor option. You probably do not, but again, your 401k very likely offers both a pre-tax and a Roth option. Less common plans, the 457B is only for nonprofits and government organizations, but they are good plans. If you do have that option, or if you have a spouse who has a 457, the important thing to know about those are that a 457 is the only type of plan where we say you can double dip. What that means is you are probably aware that if you have a 401k, there's a limit to how much you can put in each year. If you're under 50 this year in 2025, the limit is $23,500. But if you have a 403B and a 457, you can put in 23.5 to each one, which is fantastic, particularly if you and your spouse are high earners. This is a very tax efficient way to save way more money. So if, and I know 457s are kind of weird. People haven't heard of them so much. They don't always know what the rules are. But keep in mind, if you or your spouse has the option to save money in 457B, it's probably a really good idea. And I would advise you to look into it. Excuse me a second. So limits, as I said, in 2025, excuse me, highlighted there in blue. Anybody who has a 401k or 403b can save up to $23,500 in any combination of pre-tax and Roth. Excuse me, I'll let you read those for us. That happens sometimes when I talk too much. I promise you I'm not sick. Okay, if you will be 50 by the end of this year, if you will be 50 anytime before 12/31/2025, then you can put in a total of 31,000 this year. So those are important numbers to know. I'm going to send these notes to you. Well, later I'm going to send my notes to Elsie. She can send them to you. And I'll take out this 2024 numbers before I do, because that's really no longer relevant. It's too late for 2024. 2025, it's not too late. Even if you have we're exactly halfway through the year now. Today is July 1. So, but if you have a 401k through your job, that someone else is managing, it's not a solo plan, it's not too late. You can just start having more withheld from your paycheck now. Try to get to that 23.5 or that 31,000 by the end of the year. And it's not too late. Just have more withheld from every paycheck from now on, even if you hadn't started yet. And if you are self-employed, it's even easier. We self-employed people do not have to do this systematically. We could put in the whole amount all at once if we want to. So do try to get to these limits by the end of the year. Other facts about the 401k, your employer may or may not offer a plan, although most employers do now. It's really an expected part of compensation now. If you're in my older age group, you may have started your career when it was not a common thing, like I did. I mean, first of all, when I was in my 20s, I didn't care. I wasn't thinking about it, which is too bad. People who do start saving for retirement in their 20s, they retire rich. So I wish I had known. But also, companies back then, like say in the 80s, they didn't always offer 401ks, but right now they almost always do. So do be aware, if you work for somebody else, you probably have access to a plan. Your company may or may not match your contributions. If they do match your contributions, by all means, absolutely do whatever it takes to get the full match. The full match is free money. For example, the employer may say, we'll match 100% of your contributions up to 3% of your salary, or up to 10%, or up to $6,000. Whatever it is, you want to get that money, because all you have to do to earn that money is save money of your own. Very well worth it. It's free money. Always get the maximum match. If your company doesn't offer a match, don't let that slow you down. I worked with a young woman recently. She works for a very big tech company that is doing extremely well. She's in her late 20s, making 7 or 8 figures, tens of millions of dollars a year. She's in a very high tax bracket, as you can imagine. She wasn't saving anything in a tax deferred account. And I said, why not? Why aren't you, trying to reduce your taxes a little bit? And she said, oh, well, my company doesn't have a match, so someone told me it wasn't worthwhile. Not true. It's incredibly worthwhile. So I realized that I always talk in terms of maximums. Like I'm telling you right now, if at all possible, I want you to save $23,500 or $31,000 if you're over 50. I very much hope you can do that, even if it feels like a stretch. Now, I understand that not everybody is earning Silicon Valley type money and that this may sound like a lot of money. So keep in mind, those are maximums. Um, if there's no way you can spare the take home pay to do this, put in what you can. Definitely, absolutely 100% put in enough to get your full company match. Because if you're not earning a lot, you need that even more. If you're not high income, you absolutely need the free money available through the match from the company. So do not skimp on that. Even if you have to borrow money or whatever it takes, get the full match. But also, for some reason, these numbers are really out of your reach. If you can't save $23,000 this year, save what you can. Put away 5,000 or 10,000, everything counts. Also, your company 401k plan may or may not allow you to take loans from the plan. Now, taking loans from the plan is never a great idea because we really want this money to keep growing until you retire. But sometimes people think of that as a little bit of a safety valve. Like if I'm pushing you to save more in your retirement plan and you're thinking, yeah, but I'm only 30, I'm not going to be able to take that money out for years and I might want to buy a house or something. Um, Keep in mind, check whether your plan allows loans. And if so, that takes some of that pressure off of worrying about what if I need that money sooner. All right. Recommendation number one, as I said, whatever you do, always get the full employer match. That is money that you have earned. You have a right to it. You need to somehow save enough to get the full employer match. Recommendation number two, maximize your contributions even if you're saving for your children's education. You'll notice I put in this little graphic from the airlines. I know you're all familiar with this now. Notice she's putting her mask on first before she takes care of the child. I know for the parents among you, you may say, I would never do that. I would always take care of my child first. That's one reason I think the airlines harp on this. They always tell you that. Same as if you're a lifeguard. You got to look out for your own safety first because you can't help other people if you're drowning. So the analogy here is I want you to put all the money you can into your 401k or your IRA, your retirement savings account, even if you say, yeah, but I have children, I need to save for their college. The reason I'm saying this is there's a little known fact. Well, little known unless you're applying to college now. Um, if there's any chance your children might be available for financial aid, you're going to fill out this national form called the FAFSA, the Financial Aid Form, something or other. Standard form that almost all colleges in the US use to determine whether you are eligible for financial aid. They're going to look at your assets and your income. They're going to make a determination. The money you have in your retirement accounts doesn't count. So let's say you have $3 million in a 401k, but not a whole lot in your bank account. Your children are probably going to get excellent college scholarships. If you have that 3 million saved in investment accounts that are not in retirement accounts, your children are not eligible for financial aid. So this is incredibly important to be aware of. Yes, we care about our children, we want to take care of them, but you are actually increasing their chances of getting help for college when you maximize your own retirement savings. Again, think of this as the we all do better when we all do better plan. In other words, it's not in anybody's interest, for you to end up starving in old age just because you put your kids through college. Everyone wants you to take care of yourself first. It's better for the economy, it's better for the country, it's better for your family if you're okay. It's better for your children if you have taken care of your own retirement. So don't skimp on that because of education savings. Number three, try to contribute the maximum amount allowable every year. The 23,500 I mentioned, that changes each year. So you might want to be aware of that. It often goes up by about $500 a year. Try to contribute the maximum. Future you will really thank you. Next topic, IRAs, individual retirement arrangements. I'm going to take another peek at the chat to see if I'm missing anything. Oh, still nobody's chatting. Just a minute. I'm gonna just look and see if by any chance someone's trying to contact me any other way. Nope. Okay. So sometimes if I'm teaching a class in person, before I reveal a slide like this one, I'll say, what does IRA stand for? Because a lot of people think, and the New York Times crossword got this wrong last year, a lot of people think it stands for individual retirement account. It doesn't. It stands for Individual Retirement Arrangement. Now, why would I be picky about that other than that I'm a word nerd and I like things to be right, which is true? The reason is, excuse me, that it doesn't matter how many accounts you have. Lots of people over the years sort of have different IRAs for different reasons. Maybe your spouse has some, and you may end up with 5 or 6 different accounts, maybe at different banks, whatever. You have one arrangement with the IRS. What do I mean by that? What I mean is if the limit for contributions to IRAs this year is $7,000 plus 1,000 extra if you're 50 or over. But some people say to me, well, what if I have an IRA at Vanguard and an IRA at Schwab? Can I put 7,000 in each one? No, because it's not the account that matters. It's the arrangement. You're one person. The IRS is one organization. You get to put one $7,000 in. Okay, that's why we say arrangement. Same thing applies when it's time for required minimum distributions. You don't necessarily have to take the full amount from one of your IRA accounts if you have multiple accounts, but you need to take enough money out of the total accounts to meet that. So, types of IRAs. Of course, it's not simple. There's multiple types. The traditional IRA is obviously, as the name suggests, the one that's been around the longest since about 1978. That is the one where you get a tax deduction right now. You can deduct up to $7,000 or $8,000 this year if you fund your traditional IRA. Then there's the non-deductible traditional IRA. Now, that one's a little bit weird, and I don't really recommend it. The non-deductible traditional IRA, why would you bother, right? Because the whole point of the traditional IRA is to save money now by deducting it from your taxes. So the reason to put money in a non-deductible rather than a deductible is if your income is too high. There are income limits for who can contribute to the traditional pre-tax deductible IRA. If your income is too high, you probably can't do that. Some people then put money in the non-deductible traditional IRA. That is usually more trouble than it's worth. So I'm not promoting it, but I wanted you to be aware of it, partly because people ask about it. So traditional IRA, pre-tax, Roth IRA, as we know, after-tax money now, but it grows tax-free forever. Then we have these 2 other types of things that are employer-sponsored IRA accounts. Now, when I say employer-sponsored, they're usually sponsored by a self-employed person, particularly the SEP IRA, which is quite popular. That is a small business plan. So if you are self-employed, then you are both an employer and an employee of your company, and you may set up an employer-sponsored SEP IRA. It's really a small business plan. And these 2 are kind of weird because they have the word IRA in them, but they also are employer accounts. So in some ways they behave like IRAs, in some ways they behave more like 401ks. More about that in a minute. Other types of traditional IRA, there's the rollover IRA. A rollover IRA means you had a former job with a 401k, a pre-tax 401k usually, and you left that job and you rolled the money into an IRA. That in most ways is exactly like a traditional IRA that you fund through contributions, but it will probably have rollover in the title, and you just may keep that rollover money separate from other traditional IRA money, but mostly it's exactly the same. Then there's the inherited IRA. That means somebody else started it, your mother or your grandfather or a friend, could be anybody, but frequently it's a parent or grandparent. They passed away, they left you their IRA. Fantastic. It's a wonderful thing to get. But the reason it's a little bit different, and first I'll mention, I said also known as the beneficiary distribution account or BDA. That's what Fidelity calls it. So just in case there's any confusion. Now, what's different about an inherited IRA is that you probably have required minimum distributions, even though you're not old. Okay. So no matter how old you are when you inherit an IRA, probably you need to check with the bank and or check with your lawyer or your accountant or somebody and say, hey, am I supposed to be taking RMDs, required minimum distribution? The answer is probably yes, even if you're young. All right. Traditional IRA rules. The limit is $7,000 if you're under 50, a total of 8,000 if you're 50 or over by the end of the year. You can take money out with no penalty after you're 59 and a half years old. If you take the money out before that, there's a penalty for early withdrawal of 10% at the federal level And not everybody knows this, but California also charges penalties. So do not take the money out early. I mean, that's the message, right? That is the whole point of these penalties, is that this money is for your retirement. Now, if you're over 59 and a half now, keep that in mind that you're super flexible, right? I'm over 59 and a half. So if I'm not sure, oh, do I want to put money into my IRA? The answer is why not? If I change my mind tomorrow or next year or in 2 years, once you're over 59 and a half, take it out whenever you want. So at that point, you're just manipulating your taxes in a legal and fine way, in an encouraged way. Let's say I had a really high income this year. I may try to get more money into IRAs, and then next year I have a low income, I can take it out and I've manipulated my taxes in a perfectly legal way. So keep that in mind, that you want to not take it out before you're 59 and a half, but after you're 59 and a half, you're totally flexible. You can take it whenever you want. Um, Now, important, because this is pre-tax money, in the year you withdraw, you pay income tax at your ordinary rate. What do I mean by ordinary? Let's see if I have a slide on it. Not really. There's two basic categories of tax rates. Ordinary rates are what we pay on earned income. They are higher than the other type. The other type is the long-term capital gains rate. Long-term capital gains rates are 0, 15, or 20%. Ordinary income rates are somewhere between 10 and 37%. So for, I think, everybody, your ordinary rates are higher than your long-term capital gains rates. So keep this in mind when you withdraw money from a pre-tax retirement account, you're going to pay income tax at your ordinary rate. So ideally, you don't withdraw in a year when you're also getting $1 million from some other source, because you're going to be in a high ordinary tax bracket. But if you're taking money out after you've retired and you have no income from other sources, you're going to be in a low ordinary bracket. That's kind of what we hope for with this situation. These are the income limits. So this is about who can put money in a traditional IRA. Now, if you're self-employed, don't worry, we're going to talk about self-employed stuff later. But this is for people who are contributing to a traditional IRA. Oops, these are 2024 numbers. Here's my 2025 numbers. If you're single and your adjusted gross income is more than $89,000, you cannot put money into a traditional IRA. Don't worry, we have other ways for you to save. If you're married filing jointly, you can't put money into a traditional IRA if your adjusted gross income for the two of you is more than 146,000. Another important thing to be aware of, if you're married filing separately, you really can't do this. Now, a whole nother topic that I also enjoy talking about is about marriage and financial planning. But let me just give you a preview. If you live in California, married filing separately is a terrible status. In particular in California, this has to do with us being a community property state. So if you are married, it's almost certain that you should be filing jointly. Lots of nuances to that, and obviously we're not going to go into it in detail today, but sometimes clients will just come to me and say, hey, we just got married. Can you help us figure out how we should file? I'm like, that's easy. It's always married filing jointly. Married filing separately is a terrible status. And one of the many reasons, is that you really cannot contribute to an IRA. Sometimes people don't know that. They go ahead and contribute, then they file separately. Then we have a big mess. We have to take their money back out of their IRA, yada, yada. Okay, so traditional IRAs, they have income limits. However, the complexity number one, this applies only to people who have access to a retirement plan at work. So if you have no access to a 401k plan and your spouse doesn't either, then don't worry about the income limits. They don't matter. Then, you can contribute the full amount. And these only apply to deductible traditional IRA contributions. So again, if you have a high income and a traditional IRA, you can make a non-deductible contribution. I don't really recommend that, but it is a possibility. Non-deductible contributions, again, no income limits. When you take the money out of that later, what happens is the contributions you made, you don't have to pay any more tax on them because you didn't get a tax deduction in the first place. But the investment earnings are taxed when you take them out. So one of the reasons I do not recommend this for most people is you have to really keep good track of how much you contributed over the years versus how much the earnings are. And if you get that wrong, or you don't keep track, or the IRS doesn't believe you, or you don't have the right paperwork, you could end up paying tax again on those non-deductible contributions. So avoid this unless you have a really good reason for it. Next topic, Roth IRAs. Again, I've said this before, but it's super important. First of all, these are very valuable. You get no tax savings now, but you get tax-free growth. I think I put free in capital letters every time I put it here. Tax-free is great. It can make you quite well off in your old age. Notice this looks pretty much exactly like what I said on the traditional page, almost exactly. The limits are the same, $7,000. 50 and over catch-ups, $1,000. So if you're 50 and over, a total of 8,000. Notice you can withdraw the money after you're 59 and a half years old. And this is the part that's a little bit different. You need to have had a Roth IRA for at least 5 years. We call that the 5-year rule or the seasoning rule. It's a little bit weird, but one important thing to realize is this is another reason why I harp on that term arrangement versus account. So let's say when you're 18 years old, you earn some money mowing lawns, you put $100 in a Roth IRA account. By the time you're 23, you never have to think about that seasoning rule again. You're probably even by 22. There's this complication where the 5 years really gets done faster than you think. So it doesn't mean that you have to start the clock over again just because you opened a different Roth IRA account at a different bank. This is your seasoning of your arrangement of any Roth IRA account. If you had it for at least 5 years, you never have to think about that rule again. So don't let that trip you up. And then notice the penalties are the same for early withdrawal, not a good thing. And also you lose the tax benefits. You know, it's kind of not worth it if you take the money out too early from a Roth. Here are the income limits. So again, there are income limits for a Roth IRA, but they're higher than for the traditional IRA. So for example, I think the single phase out, this is for a person filing their taxes as a single person. If you were trying to contribute to a deductible traditional IRA, I think it phased out around $89,000. This phases out at 161. Big difference, right? Married filing jointly, you have to have adjusted gross income of 240,000 before you're ineligible for a Roth. I don't know what you earn. As I said, I work with a lot of extremely ridiculously highly compensated people. For normal mortals, 240,000 is a lot of money. These are pretty high incomes that would still allow you to contribute to a Roth. So don't rule this out. These are the 2025 limits. Again, this is a review of the tax implications. In the year you withdraw, you pay no income tax. Small business plans. Now, once again, I am peeking at chat and I'm seeing nothing. I just want to encourage you to participate if you will. Put in any questions or any comments or any confusion into the chat and I will notice. If by any chance you would rather talk verbally, orally, that's totally fine with me. You may have to unmute yourself. My guess is you're probably automatically muted, but it is fine to try to speak up if you would like.
Heather, the chat is open. I'm not sure why you're not
Okay.
seeing it. They are putting messages in there. I can try and open up the Q&A to see if you're able to see those notifications.
Oh, wait a minute. Are you saying you do see something in chat?
Yes, they've been
Oh,
chatting.
thank you so much. Thank you. Okay. I can see it for some reason. I
Okay.
didn't realize it. Thanks, Elsie, for
Yeah,
checking
no
in on
problem.
us. And let's see. Just a minute. I'm going to take a minute and read those. Okay. I don't know why it's a little bit weird today. Okay, we have some notes from Elsie, by the way, welcoming you all. And she says she's recording it. She's going to send it to you later. So that's good. Oh, good. I see one self-employed, one employed. Sorry that I wasn't able to notice that before. Aha, I see 3 self-employed. See one person saying hello. I appreciate that. I know I was telling you, put anything in. Okay. Oh, and I see one person says both self-employed and employed. That's interesting. Good. That has its own implications. Just a second. W2. Okay, good. Someone says Heather chat is on. Again, I apologize. I don't know why I couldn't tell. Okay. And okay, someone says, can you put 23,500 into both a 401k and a small business IRA? Great question. Susan, thank you for asking that twice. Now that I get why I wasn't seeing it. So really good question. Can she do both a contribution to a 401k, the 23.5, plus contribution to a small business plan? The answer is yes. So here's the deal with that. That 23.5, that is an employee contribution. And you get one version of that in most cases. There are a few weird exceptions, like the 457. 457 lets you double up on that. I don't think you probably have that. So in most cases, you get to make one employee contribution of $23,500. Now, let's even leave aside the self-employment question for a minute and say, what if you just change jobs 3 times during the year? You work for Apple for a few months, you work for a real estate firm for a few months, you work for Google for a few months. They each have a 401k. You can put a total of 23.5 this year into all those plans. So maybe you put in 23.5 in your first company plan to make sure you got the full match. Then you change jobs, don't contribute anything else. Okay, that 23.5 is your amount as an employee. But if you are self-employed, then you basically fill 2 roles. You're an employee and an employer. The employer contribution is by job. So let's say you're self-employed and you have 2 or 3 different businesses with different employer plans. You can put in the employer contribution to each of them. Or let's say you work for a big real estate firm for 6 months of the year. You put in your 23.5. The company has a fabulous match. They put in 40,000 on your behalf. That's great. You've got this huge 401k plan, but then you have a business on the side. You can't put in another 23.5, but you can put in another, let's see, 40 or 50, large number. I'll have the exact number for you in a minute, but you can put in the full employer contribution to your self-employment plan. So I hope that part is clear, and I'll continue to talk about that as we go forward. So these are the 3 major types of small business plans. And I'll tell you the first one, less so. By the way, SIMPLE is an acronym. It stands for something like small, I don't know, small employer plan of some type. But the SEP and the SOLO are much more common. So we're going to focus more on those. And the SEP has been around longer. Oh, there we go. There's the acronym, Savings Incentive Match Plan for Employees. Where I have seen these, where I've even implemented these, is when I've worked for a small organization that maybe you really can't afford the paperwork to start a whole 401k, but we want to give our employees an opportunity to save something. Simple IRA is often good for small business with employees. In 2025, employees can put in up to 16,500. If they're over 50, they can put in 20,000. So what you may be noticing is, hey, it's got IRA in the name, but that's a lot better than the 7,000 I could put in on my own. That's why it's good. Now, one thing about simple plans is the employer has to contribute something. Let's see. There we go. The employer has to either put in 3% or 2% of compensation. Not a bad deal. It's still simpler than a 401k for an employer, but they're not super popular. These are the more common types of self-employed plans. When I was studying for the Certified Financial Planner exam about 15 years ago, I remember in my crash course to get ready for this big professional exam, they said, if you don't know the answer is SEP IRA. SEP IRAs were really popular then. They still are popular. They still are really good. If you have one, keep funding it. But the solo 401k has risen in popularity over time, and for many people is even more advantageous in that it allows you to save even more money. So starting with the SEP IRA, if you have one, great. Do not feel like you need to close it. It's great, and they've gotten even better lately. It stands for Simplified Employee Pension. I always forget that. To me, it always sounds like it ought to be self-employed plan. But basically, Simplified Employee Pension. Doesn't matter. Everybody calls it a SEP. Maximum contribution in 2025. Oops. I'll update this before I send it to you. This is 2024. It should say 2025. It's still the smaller of 20% of your net earnings, but I think that 70,000 has gone up to 71,000. Note that there's no over 50 catch up. Why not? Because in a SEP IRA, there are no employee contributions. This is employer contributions only. So the 23.5 doesn't even apply. It's not even relevant. But if you earn a lot of money, because remember, it's the smaller of 20% of your net business income. So you have to earn kind of a lot of money. That's somewhere, I think that's about $280,000 you'd have to earn in order to maximize this employer contribution. But let's say you have a regular job by day, you put $23,500 into that 401k at work, doesn't affect your SEP at all because there's no employee contribution to a SEP. So you can totally maximize the SEP contribution. It's fantastic. Withdrawals and penalties, same as for other types of retirement plans. Now, one tricky thing about a SEP IRA is you have to contribute. Well, you don't have to contribute for yourself, but any year that you contribute for yourself, you also have to contribute for your employees if they meet certain requirements. It's an employer plan. It's very easy to establish. It's very simple. And you can establish it up to your tax filing date plus extensions. So you probably have in your head April 15th. A lot of things have to be done by April 15th. Like if you're making an individual IRA contribution, it has to be done by April 15th. The SEP IRA is good for procrastinators because if you have filed an extension, then you don't have to file your taxes till October 15th. You can still make a SEP IRA contribution for the previous year up to October 15th. So SEP is good for people who didn't get things done on time. They're inexpensive to manage. They allow a much bigger contribution than you can put in a traditional IRA. That's that $7,000, but often smaller than a solo 401k. It's very flexible, like an IRA. You can fund it in years when you want to, skip it in years when you don't. And this is brand new. There used to be no Roth option in a SEP IRA. Now there is a Roth, so it's even more flexible. Disadvantages, no over 50 catch-up, no employee contributions. Now, that's not a problem for you because you're the business owner. You as the business owner, you can put a large amount in from the profits from your business. That's called an employer contribution. So as long as you're the business owner, the fact that there's no employee contributions is not a big deal. One of these disadvantages, though, is if you have employees, you must contribute for them if they meet certain criteria. Here are the criteria. If they're at least 21, if they've worked for your business for 3 of the last 5 years, and you've paid them at least $750 in compensation in one of those years, in 3 of those years. So then you have to contribute something for them. So who's it good for? It's good for self-employed people who have employees, because if you have any employees, you cannot have a solo 401k. But it's especially good if your employees are young, part-time, or temporary. So one personal example, my brother-in-law is a jeweler. He owns a small jewelry store. He's a designer. He hires a lot of interns, college students. They work for him for the summer, pays them a relatively low wage. I think sometimes they get college credit. They work for him maybe a couple of summers and they move on. No problem. He doesn't have to contribute for them. They have not worked for him in 3 of the last 5 years. Some are not 21. Some haven't earned a lot of money. Not that he abuses them, he doesn't, but young people, maybe they just work 2 summers, everybody's happy, everything's fine, doesn't have to contribute for them. And yet he can still maximize his own contributions, which is great because I want him taking care of my sister and their family and, his whole family and himself. So the SEP IRA is particularly good for people who don't have full-time employees, don't have long-term employees, so they don't have to contribute for them. Now, the solo 401k, you can usually contribute even more than for the SEP, but a big catch for the solo is you can't have any employees, except possibly your spouse. You can hire your spouse to work for your business and you can still have a solo. If you hire anybody else on a W-2 basis, even if it's just a student, even if it's just for a summer, you can't fund your solo 401k that year. So that is the big distinction. If you have no employees other than your spouse, I'd push you to a solo 401k. If you have any employees beyond your spouse, I'd say the SEP IRA is the plan for you. That's how you make that decision. Now, one thing about the solo 401k, different companies call it by different names. Schwab calls it the I-401k. Vanguard calls it the I-401k, but with a little I. Vanguard sometimes says individual 401k. Fidelity sometimes calls it the self-employed 401k. All these mean exactly the same thing. Keogh 401k, one participant, UniK, these are all the same thing. There's a solo 401k. So don't let these names throw you off. Who can it cover? One business owner and one spouse, if your spouse works for your business. Now, if it's your long-term boyfriend or the mother of your children or your registered domestic partner, that's not your spouse, okay? California, your spouse has to really be your spouse. You have to have a legal marriage in order for your spouse to be coverable. Now that I know the chat is working, and again, I apologize for not really sooner, I'm going to peek and see if I'm missing any questions. I really appreciate that you were participating when I thought you weren't. Okay, I don't see anything new. So I will continue, but feel free to continue doing that also. So in 2025, the maximum you can put in to a solo 401k is up to $70,000, or if you are 50 or over, up to $77,500. If you are a high earning self employed person, this is a fantastic plan. Withdrawals and penalties, same as other types of retirement accounts. Now, the 77.5 has certain limitations based on your business income. And remember that as a business owner, you hold two positions. You're an employee and you're an employer. So why do we like solo 401ks? It's like a regular 401k, but a lot less paperwork. You do not have to do as much work as a business owner who has lots of employees. You can contribute for yourself and you can contribute for your spouse if they work for the company. They're easy to establish and inexpensive to manage. If you qualify, if the second item here qualifies you, that it's only you and maybe your spouse, if you qualify, this allows the biggest contributions for a business owner. So this is the best type of plan if you qualify. It's very flexible, funded in years when you want to, don't when you don't. It's not like if you own a big company and you have this very formal 401k plan and it says we will always match employer plans or, employer contributions. If you run a big company, you're going to be really bound by the rules of your 401k and you're probably going to have to contribute every year. If you are a sole proprietor, or, if you're an LLC or an S Corp and it's just you, totally flexible. Fund it when you want to, don't fund it when you don't want to. More solo advantages. You do have the over 50 catch up, which is not a thing in the SEP IRA. You have a Roth option, which has just recently become a thing in the SEP. You have an after tax option, and loans are possible. These last two items are a little bit more complicated. You'll need help setting up one if you're going to do those things, but they're not necessary. Elective deferrals. Let's jump to 2025. So your elective deferral is up to 100% of your compensation up to the annual contribution limit. That, as you know, is $23,500 in 2025 or $31,000 if you're 50 or over. And why do I say up to compensation? If you are a sole proprietor or an LLC, compensation doesn't exactly have any meaning. It just means business income. Because I'm a sole proprietor. I don't pay myself a salary. Any net income from my business is my money. So, and I'm over 50, so that means my employee contribution is 31,000 as long as my net business income is at least $31,000. That's the employee contribution. Now, if you are an S Corp, and I know some of you probably are, an S Corp is sort of this weird in-between thing where you're an official corporation, even though it may be just you. S Corp, as you probably know if you have one, an S Corp does have to pay salaries. So even if it's just you, you are paying yourself some kind of salary compensation. In that case, again, your employee contribution cannot exceed the amount that you paid yourself in salary. So that's the employee part. Then we have the employer part, because even though I'm a sole proprietor, an employee and an employer. So first I can put in 31,000 as my employee contribution as long as my net business income is at least that much. Then I can put in up to 25% of my net income from the business up to $77,500. That 77.5 includes the 31. So in other words, if I can do the math in my head, I think if I earn enough money this year, I can put into my solo 401k a total of $46,500 as an employer contribution. See how great this is? So I'll tell you, for example, last year I did have a good year. I had a high income. And when I was first working on my tax return, it looked like, first of all, it looked like I had to undo the Roth IRA contribution I had made because my income was too high for that. Second, it looked like I wasn't going to get any subsidy on my self-employed health insurance because my income was too high. What else? Various things that were affected by this. But then I said, now wait a minute, filling out the tax return. I said, I'm going to put a total of $77,500 into my pre-tax solo 401k. Zoom. All of a sudden, my taxable income and my adjusted gross income zoomed way down, and all these other things became available to me. Various credits, deductions, etc. I qualified for because I had significantly lowered my taxable income. Very valuable thing to do. And my money now is growing tax-free. So super valuable. Solo versus SEP. I've already said the main differences. I'm going to say them again because they're really important. And by the way, people often say, can I have both? The answer is you can have both open at the same time, but only contribute to one in any given year. Okay. If you've got an old SEP, but you don't want to contribute this year, fine. Open a solo, if you qualify, open a solo, just let your SEP sit there and grow and don't worry about it. Or vice versa. Let's say you have a solo 401k, but this year you hire an employee. Okay, you no longer can contribute to the solo, but the one you already have is totally fine. Just let it grow. Don't worry about it. It's totally fine. Just don't contribute this year because you have an employee and you're not eligible to contribute. So main differences. The solo 401k includes the employee deferral and the profit sharing contribution. That's the employer portion. Whereas the SEP IRA is purely profit sharing, no employee contributions. More differences, it's easier to contribute the maximum amount in a solo because of this salary deferral part that's not available. A solo 401k also includes the over 50 catch-up, which the SEP does not allow. The solo 401k may allow loans if you set it up that way. And if you set it up that way, you can make after-tax contributions. So the maximums, now we're thinking you're under 50. To contribute the maximum of 70,000 to a SEP IRA, you have to earn at least 370,000. To contribute the maximum to a solo, you only have to earn at least 244,000. So you can get to the max quicker. And remember, with the solo, there's that extra $7,500 as over 50 catch up. So bottom line, for self-employed people, solo is usually the best option. But if you have any employees beyond your spouse, do the SEP. Now, how do you do it if you want a solo 401k? First thing is you need an employer identification number, EIN. That's easy. And do you see that word free? Whoops, I love that word free. An EIN is easy to get. You get it through the IRS. You go to irs.gov. You just apply for it. You get it. It's free. And I'll just mention, even if you're not sure you're going to open a solo 401k, if you have a small business of any kind, I encourage you to get an EIN. Again, the word free and easy. I like that too. And one more reason is an EIN is something you can use sometimes instead of a social security number. So for example, if I'm doing some work for somebody and they're going to pay me as a consultant, they're going to send me a 1099. And I do consulting work for various people. So I get a bunch of 1099s. I don't want everybody having my social security number. And sometimes we're sending these forms back and forth, over the internet. Getting your social security number out in too many places is a little risky, right? We want to protect that number. Anything related to my business, I can use my EIN instead of my social security number. So that's fantastic. It protects my privacy some. So that's just a little extra impetus to go ahead and get an EIN if you are self-employed in any way. All right, so you need that for the solo 401k. Then you choose a provider, Fidelity, Empower, E-Trade, Schwab. By the way, at the moment, I don't really have a favorite. My favorite used to be Vanguard, and they got out of the business last summer. They sold their business to Ascensus. So that's where mine is right now. It's at Ascensus. I'm not in love with it yet. I'm giving them a chance, but so far I don't love their interface. So any one of these can do it though. If you've already got money at Fidelity or E-Trade or Schwab and you like working with them, set up your solo there, no problem. Ubiquity and Empower and My Solo 401k, they really all specialize in retirement plans. You probably don't have other money there like you might at Fidelity or Schwab or Vanguard, but they are perfectly good at solo 401ks. So you get your EIN, you choose your provider, and then you just fill out their application and they will tell you what you need to do. And again, it's really not very complicated. So solo is a great thing to do. Next topic. I know I've been talking a lot about maximize everything. And what if you earn a whole lot of money? How can you reduce your taxes? Not everybody earns a whole lot of money. I realize that. And I don't want to be insensitive about that. Especially maybe you're young, maybe your business is just getting started. There's all kinds of reasons why maybe you're not earning a huge income this year. So I want you to know about the Savers Credit. And one reason I want you to know about it is it's very valuable. And the people who are eligible for it, because they're low income people by definition, they probably don't have a financial advisor. They may not be aware of it. So I want you to know about this. Also, maybe you're earning a lot of money, but your kids aren't, or your friend isn't. I want you to share the word about the Savers Credit. You're eligible for the Savers Credit if you're at least 18, if you're not somebody else's dependent, and you're not a full-time student, and if you don't have a super high income. I'll define that in a minute. What's great about it is a credit. Now, credit is better than a tax deduction. A credit is basically the government giving you money. You can get up to $1,000 in rebate on your taxes if you qualify for this. So 2025, let's say your adjusted gross income, you're married and your adjusted gross income is $47,500 or below. Then if you put $2,000 into a qualified retirement plan, you get $1,000 cash back. Fantastic, right? You get a 50% tax credit if you're married filing jointly and your total family adjusted gross income is below 47.5. So, but let's say you're single, look down here in the bottom right corner. If you're single and your total income is below 39.5, and by the way, that very well may be true if you're young or if your kids are maybe in their first job or something, they might make less than that. They can put money in their retirement account. That includes a 401k, a solo, a SEP, an IRA, any type of retirement account, and they will get a tax credit, which is free money. So it's incredibly valuable. And why do we have it? The reason is that, and some of you, as I said, may have had this reaction. Why is that lady talking about high income people? I'm not high end. I can't afford to save for retirement. I think that's a very easy way to feel like, I can't afford this. I can barely pay for groceries. Stop talking about saving for retirement. This is to get those people to opt in and to help everybody realize, yeah, we know it's tough to make ends meet. We know you don't have lots of extra cash sitting around, but get started anyway. This is to get people into the system, to get them used to saving for retirement, even when they feel like they can't afford it. It's to say, hey, here's basically a cash bonus. Here's some free money to get you started. So again, I want you to be very aware of this. And if you don't feel like you can memorize these numbers right now, no problem. At any point, just Google Savers Credit. I've copied this directly from the IRS. They change the income limits a little bit every year, but notice you can get a tax credit if you're single and make less than 39.5, or if you're married filing jointly and make less than 79,000. There's a little free money available to you just as a reward for saving for retirement. RMD's a whole nother topic. I'm going to stop and peek at your questions again for a minute to make sure I'm not missing anything. Okay, I don't think I am. All right, back to RMDs. So if you spend any time with people like me, people who are financial advisors or tax pros, we tend to say RMD all the time. I apologize if I use any acronyms you're not familiar with. Do feel free to let me know if I'm ever saying something you're not familiar with, because sometimes we get in these habits. RMD stands for Required Minimum Distribution. Now, if you are under 72 years old, this is not your problem, except if you have an inherited IRA. Inherited IRAs sometimes trigger RMDs in young people, but generally these only apply to people who are on the older side. So almost every type of pre-tax account has RMDs. Roth accounts do not have RMDs. It's one more great thing about Roth accounts. Almost every type of pre-tax account does. Traditional IRAs, SEP IRAs, simple solos, 401ks, and the inherited IRAs. When do you have RMDs? If you were born 1950 or earlier, your RMDs begin in the year you turn 72. Technically, by April 1st of the year after you turn 72. If you were born in the 50s, basically, your RMDs begin at age 73. And for the vast majority of us at this point, we don't have to worry about RMDs until we're 75 years old. This is a good thing. It doesn't mean you can't take your money sooner. Remember, you can take your money out of any retirement account with no penalties when you're 59 and a half. But it means between 59 and a half and 75, totally up to you. take money out if you want to, don't if you don't want to. Totally up to you. That's a very flexible time in your life. And you'll make the decision for yourself based on your tax bracket during those years. But once you're 75, you have to start taking some money out of your 401k. Getting a weird notice to make it go away. Okay. When do you have to take from an inherited IRA? This, of course, is important if you have been fortunate enough to inherit an IRA, which is great. There are new rules about this. A lot of changes were made with inherited IRAs in the last couple of years. And in fact, they got so confusing with these various acts that went in, partly related to COVID. There were a lot of adjustments in retirement laws recently. They got so complicated that for a while the IRS said, you know what, we don't even know right now. They finally clarified everything just about a year ago, and they gave us a little grace period. But the grace period has ended now. As of 2025, you do need to start doing this right. But if you have inherited IRA, I'd check with a professional because it is a little bit confusing. But usually it's super important whether you inherited it from your spouse or from anybody else. From your spouse, that's ideal. Again, as I said, in California in particular, but everywhere in the US, spouses have special rights. Marriage is a good thing in this country. So if you're a spouse, you probably have much more flexibility about your inherited IRA. But if you inherited it from your father or your grandmother or your neighbor or your cousin or anybody who's not your spouse, your brother or your sister, again, anybody who's not your spouse, you probably have to both empty the account completely in 10 years and take something every year based on your life expectancy. So if you have inherited an IRA, you probably have a required minimum distribution this year, regardless of how young you are. So I would check with someone and make sure. It's a little hard to understand this probably all on your own. You want to get it right. All right. That's for inherited IRAs only. Every other type of retirement account, no RMDs till you're at least 72 and probably 75. Somewhat new topic, words matter. Rollovers, contributions, conversions, distributions. I have people say strange things to me all the time, like we moved money from our IRA to our 401k, or we distributed this, or, they'll say different things. Every one of these words has a specific meaning, and it is important to get it right. So a rollover means you moved money from a pre-tax, some kind of pre-tax account to another pre-tax account, or some type of after-tax account to another after-tax account. A rollover has no tax consequences in the present. The most common type of rollover is you have a pre-tax 401k from an old company, you leave the company, you roll that money into a pre-tax IRA. No taxes involved. Jump down to items to conversion. A conversion is a taxable event. So sometimes conversions make sense, but be very clear whether you are or are not making a conversion. The common type of conversion would be, let's say you have a big balance in a traditional IRA, you want to get more money into a Roth. You can convert as much as you want, any year you want, but you pay full ordinary income tax on the amount you convert in the year you converted. So the best time to do Roth conversions is in years when you make a low income. Maybe you went back to school, maybe you're very young, or maybe you're starting a new business and you have a low income this year. Great time to convert. But a conversion is a taxable event. So don't say that unless you mean it. And if you're talking to your broker or your tax person or whatever, make sure you get the terminology right. Now look at the second item, contribution. Contribution means you're putting in new money in the current year. So that's where those limits apply. Like that's where you can't contribute more than $7,000 to a Roth IRA, but you can convert any amount you want. Maybe you have $1 million in your old 401k and you want to convert it to a Roth. You can convert anything you want, but you can only contribute 7,000. And if it's 401k, you can only contribute 23.5. Also, income limits apply to contributions. There are no income limits on conversions. Anybody can convert anytime. The only drawback to conversions, again, is you are triggering taxes, so be careful about that. A distribution means you're taking money out of an account. If it's a pre-tax account, a distribution is a taxable event. Recharacterizations are less common than they used to be. Essentially, it means you made a mistake. Like you put money in a traditional when you meant it to be in a Roth or vice versa. You're going to contact your tax person and your broker at that point. They're going to help you with the recharacterization. Uncommon. You're probably not going to do that. These other words all matter. And if you are working with a tax pro or somebody, they're going to be specific. So just make sure that you're echoing back to them. Like if they say do a conversion, don't do a rollover. Okay. Use this, or don't call your bank and say, hey, my tax pro said I should roll this money over. No, your tax pro said you should convert. Okay. Just be a stickler about words when it comes to these things because they do matter. Now we get to advanced topics if we want to. We are at about 12:30. We have another half hour, and there's lots of things we could talk about. So I'm going to peek again and see if there's anything you want to know about. I don't think I have new questions. All right, so I will keep going on what I have. But note that these things are not for everybody. The backdoor Roth, the mega backdoor, and the 529 to Roth maneuver, these are not for everybody. So if you're already feeling a little confused, it's okay to kind of tune out right now. You don't have to do these. In some cases, you probably shouldn't do these. So one thing I'm going to mention up front is on my website, and at the end of this thing here, I'll show you my website. Actually, I'll jump there now. There we go. My website is clarityfinancialca.com. CA as in California. So clarityfinancialca.com. And I tell you that not because I'm trying to drum up your business, but because there's 2 free documents available on my website. I thought I listed them here, maybe I didn't. Okay. On my website, there are 2 documents. You're welcome to just sneak in and get them. I'm not going to collect your data. I'm not going to spam you. Just visit, download them. One document I wrote is called How Not to Mess Up Your Backdoor Roth. Because I'm going to talk to you about backdoor Roths right now, but people make so many mistakes with them that often they're not even worth the trouble. So don't do a backdoor Roth unless you've exhausted your other options. Like if you have access to a 401k or your spouse has access to a 401k and you're not maximizing that, do that first. That's way easier than dealing with the backdoor Roth. Okay, so I am going to tell you about it, but if you're considering it, I want you to download my free document called How Not to Mess Up Your Backdoor Roth. Second document you can download for free on my website, clarityfinancialca.com. The other document is called something like, Should I Roll Over My 401k? There are pros and cons. When you leave an old job, you can roll your 401k to an IRA, or you can leave it where it is in most cases. There are pros and cons to both approaches. You can also sometimes roll that old 401k into a new 401k at your new job. So I have this big chart I made with all the pros and cons. And I recommend that if you're considering that, that you do download that free document and look at the pros and cons before you do it. Okay. Again, not a commercial for me. I'm happy to be talking to you today. You're getting this talk and this education because of the dues you pay to the Orange County Realtors. So I'm not here to make money, but those documents can be important. All right. The backdoor Roth. So first of all, these are both really silly terms. And the mega backdoor is not a term you're going to see anywhere in IRS logos or, documentation or anything. Mega backdoor is sort of a slang term for a complicated maneuver that not everyone has access to. So number one warning, when we talk about the backdoor Roth, it does not work for people who already have money in a traditional IRA. So if you have been contributing to a traditional IRA over the years, or you've rolled over money from an old 401k to an IRA, don't do the backdoor Roth. Okay. It will end up triggering a tax bill for you. So what is it? So first of all, we've already talked a lot today about why Roth IRAs are great, right? Roth IRAs offer tax-free income for the rest of your lives. They're fantastic. And Roth IRAs have no required minimum distributions. Also fantastic. So that's why we want as much money as possible to get into Roth IRAs. But there's the annual contribution limit, right? You can only put in $7,000 or $8,000. Not a huge amount of money for someone who's earning a lot. And there are income limits. You cannot contribute directly to a Roth IRA if I'll update these later again to 2025 numbers. But remember, it's not a huge amount. Like if you're single, you cannot contribute directly if your income is more than about 163, I think this year, and about 244 if you're married. If you're married filing separately, can't contribute directly to a Roth IRA at all. So the backdoor Roth is a trick that lets a high income person get money into this very valuable savings opportunity, lets a high income people contribute to a Roth IRA even though the basic tax law says high income people cannot contribute to a Roth IRA. So this is a trick, but it is legal. Okay. So the way that it works is anybody can contribute to a non-deductible traditional IRA. There's no income limits. And there's no income limits on who can convert money from a traditional to a Roth. So if you are a high income person and you have no money in traditional IRAs, then you put 7 or 8,000 into a traditional non-deductible IRA, and then as soon as possible, you convert it to a Roth IRA. It's this weird multi-step process, and you have to do the steps right. You can't circumvent it. If you've got a high income and you put money directly into a Roth, you're in trouble. You're triggering fines, problems, tax issues. Don't do it. If you're a high income person, you cannot put money directly into a Roth IRA. But you can do this ridiculous and complicated maneuver where you put money into a non-deductible traditional and then you convert it. For very high income people, this is often worth the trouble. Just don't mess it up. Okay, if you're going to do it, I would suggest you talk to a tax pro and make sure that it makes sense for you. But it's, even if you're doing it, it's not a whole lot of money. So is it worth the trouble? That's where the mega backdoor comes in. Now, very important thing about a mega backdoor, it only works if you have a company plan that allows it. So if you're self-employed, this is not a thing for you, probably. And if you work for most companies with 401ks, it's not a thing either. Where we see it a lot now is tech companies because they're all competing with each other. So you can do it at Tesla and Amazon and Google and Carvana and a lot of big tech companies, Palantir, because they're competing with each other for the same talent in Silicon Valley. They usually have the mega backdoor. Apple has it. Facebook has it. The other place where I see it is the university systems in California. I used to work for the University of California at Berkeley. The whole U of C system, you can do the mega backdoor. I think the same thing is true for California state system and maybe some others. So how do you know? I already said the mega backdoor is a silly term and it doesn't appear anywhere in official literature. So how do you know if your company plan allows the mega backdoor? The answer is, first of all, you ask your colleagues, like talk to the most savvy person who knows how to make the most out of employment benefits. Clients often say to me, oh yeah, we have this Slack channel where we talk about stuff. And there's this guy who's always working the angles. So if you know somebody at your company who's talking about the mega backdoor, ask them about it. Partly because each company manages it a little bit differently. So if somebody else is doing it, pick their brains. But if you don't know somebody who's doing it, the way to find out if your company allows this is you get your summary plan description. If you work for a company and they have a 401k, they also have a summary plan description. It's a super boring document. They probably handed it to you when they hired you, or they said, hey, it's on the HR website, go get it anytime. So I promise you it does exist, even if it might be a little tricky to find. It's called the summary plan description. It's an official document that explains how your 401k plan works. Then you scan through that, you look for after-tax contributions. That's the key term. Now, as I've mentioned before, there's 3 categories in some 401ks. Almost all 401ks now let you make pre-tax and or Roth contributions. This is a 3rd category called after-tax contributions. A little confusing because a Roth contribution is an after-tax contribution, but this is specifically called after-tax contributions. If your plan allows that, then what you do is you contribute to your 401k plan's after-tax account. Then you open a Roth account and you convert the money from the after-tax 401k to the Roth IRA or the Roth 401k. What's great about the mega is that you can get up to that $77,500 in total. So remember, your employee contribution is normally limited to $23,500. With the mega thing, this after tax, you put the $23,500 into your normal pre-tax, because I'm assuming you're high income if you're going to bother to do this. So you put the $23,500 into your pre-tax as usual, then you put another 46,000-ish dollars into the after tax. It's growing in Roth money, tax-free for the rest of your life. It's incredibly valuable if you're a high income person. So there's an example. Okay, new topic, sort of. Any Roth account. Once you get money into a Roth account, I want you to invest it aggressively. Aggressively usually means in stocks. Usually you want a low fee, highly diversified stock fund. The reason is that the whole point of Roth IRAs is the tax-free growth. So we want your money to grow. If you put your money in a Roth IRA account and you just sort of leave it there in cash, you kind of wasted a lot of the benefit. What we want is, that you put it in something high growth, so it's worth 10 times as much when you retire, and all that growth is free. So remember to invest that money. What's new? Tax laws are constantly changing, which is why anything I said today, I want you to check it with your own professionals, make sure whether it applies to you, make sure, how your situation fits it, because things are always changing. One thing that's new this year for the first time is we have this weird new extra catch-up. I keep talking about the $7,500 catch-up for a 401k if you're over 50, the $1,000 catch-up if you're over for an IRA if you're over 50. Those things have been around since 2001, but we have this weird new catch-up in 2025. If you are a very specific age range, if by the end of the year you're going to be 60 to 63, your catch-up is 11,250 instead of 7,500. If you're going to be 64 by the end of the year, you don't qualify. If you're going to be 59 at the end of the year, you don't qualify. Just this weird little cohort of people who were born over the course of 4 years, they have a higher over 50 catch-up amount in their 401k plan. It's a good idea to maximize everything available to you, especially if you're about to retire. So in summary, because I know I talked about a huge number of things today. This one I didn't even talk about yet, but I'm going to harp on it for a minute. Beneficiaries. Every retirement plan that you have allows you to add beneficiaries to it. And I want you to do it because it's an incredibly effective type of estate planning. It's also cheap, easy, and free. To make a will and a trust and the other parts of a formal estate plan, you have to hire a lawyer. It's a good idea. I advise you to do it, but I don't think you're going to get around to it today. And maybe you're not going to get around to it in the next few years, but you can check your beneficiaries today. You can do it right now on your phone without even being rude. It's cheap, easy, and free. You change your beneficiaries anytime. You don't need a lawyer, and you don't need to tell anybody. You just do it. You can name as many beneficiaries as you want. If you have 6 kids, make each of them 1/6 beneficiary of your 401k. They don't have to know who they are. But really important, beneficiary designation outranks a will. So even if you paid $5,000 to an attorney and they made you a will that said everything goes to your kids, if your old IRA says it goes to your high school boyfriend, your kids are out of luck. Beneficiary designations are incredibly powerful. They say who gets your retirement money when you're gone. So I want you to check those. I harp on that in every topic I talk about. Top 10 tips. When it comes to retirement plans, never, never, never miss out on a company match. That is absolutely free money and you have a right to it. So even if you feel like you can't afford to save much for retirement, put in enough to get that full match. Number 2, maximize your tax deferred and tax-free savings if at all possible. Know the limits each year, which I've mentioned a billion times today, but you can also Google anytime. I forget sometimes. I just Google max 401k 2025. You'll get it in an instant. Don't go over those amounts. I've certainly worked with clients who maybe change jobs. They put a total of too much in there and then we have to take it out. It's kind of messy. So don't go over that amount. If you're saving for your children's education, fund your own retirement plans first and then fund your education savings accounts. When you leave a company, remember you do not have to roll over your old 401k. You can if you want, but you don't have to. And don't ever roll money into a traditional IRA if you're ever planning to do the backdoor Roth, because you'll mess yourself up. If you have a small business and no employees except your spouse, get a solo 401k. If you own a small business and you do have some employees, get a SEP IRA. If you have an employer plan, so this is the question someone was asking, at least one person has both a regular W-2 job and a small business of her own. If you have both, fund your employer plan first. It's a little bit complicated why. I gave a talk a year or two back to some group of realtors about QBI in the real world. It was a bit of a complicated topic, and I don't think they loved it, quite frankly. QBI stands for Qualified Business Income Deduction. It's a very valuable deduction. It gets all of us small business people an extra 20% discount on our taxes from our small business. So that's why, without going into too much detail now, that's why if you're going to reduce your taxable income, I want you to do that from your W-2 job first. because your income from that is taxed at a somewhat higher rate than your self-employment income. Okay. If you can maximize all your retirement savings, fantastic. But if you have options, fill up your 401k plan first. And if you're married, and your spouse has a regular job and you have a business of your own, make sure you fill up the spouse's 401k employee plan first. Okay. If possible, if your income is within the limits, try to fund a Roth IRA each year in addition to whatever else you do. Remember to invest your Roth plans aggressively. And if you have a regular company job with a 401k, check and see if they offer the mega backdoor option. They may or may not. Okay, FAQs. This means uh, frequently asked questions that I get often. When should you do this? The answer is now. These are questions I get all the time. But shouldn't I? Well, we're thinking of buying a house, or what about, what I need? I don't understand the stock market yet. Should I wait? No, you shouldn't wait. Nobody understands the stock market. Yes, elections can cause turmoil, but you know what? There's been turmoil since money has been invented. I'm old enough now that I have seen market crashes and I've seen market recoveries. And even the worst crashes, somehow we bizarrely always recover. We don't know when, and we don't know how fast, and we don't know by how much. But the fact is, there's always turmoil. So don't wait for it. Go ahead and get started. Don't say, oh, should I wait till the markets settle down? Nope. Don't wait till you know what you're doing. Nobody really knows what they're doing. Nobody really understands the stock market. If you have a financial advisor, sure, ask their opinion. But I'll tell you right now, your financial advisor will say, yes, you should save for retirement. So no, don't wait for any of these things. Start now. I had a client recently say to me, and I thought this was ridiculous. When I was 40, I felt old. I now realize 40 is not old at all. This guy came to me about financial planning in general. And he said, is it too late? Should I do any planning? I'm already 40. I said, yeah, you should. I mean, I could show him numbers like how much better off he'll be if he starts doing some things right at 40 instead of 60. It's an incredible difference. So the best time to start, sure, it was 30 years ago. Second best time is today. So no, you're not too old. It's not too late. If you don't know how to invest your retirement fund money, totally fine. Don't worry about it. Just choose the target date fund or the lifestyle fund. Those are those ones I was talking about where the inventor of the fund mixes it up for you. It will automatically include some US, some international, some stocks, some bonds. It will already be diversified, so you don't have to worry about choosing 5 different funds. Just choose one of these, and then later, if your advisor says, oh, you really should be in this or that, no problem. You can change any time with no tax consequences. So go ahead and get started. Okay. This is me. As I said, if you need to reach me, I'm at hcliston at clarityfinancialca.com, but don't feel you need to write to me. Elsie's going to send you notes later after I clean them up a little bit and send her a copy. But you're welcome to visit my website anytime if you want something. Oh, there's the documents. I did write them down. These are the 2 documents that I recommend to a lot of people. They're both free. They're both available on my website. Download them anytime. These are questions that come up a lot that I hope you'll find helpful. Key numbers for 2025, other resources. If you're looking for a financial advisor, these are good places to look. Let'smakeaplan.org will help you find people who are certified financial planners. These are all good places. If you're looking for a financial advisor, look for the word fiduciary. That's important. Okay, so I'm going to jump back to here for a minute and look at questions. And please, this is your last chance. We're down to our last 10 minutes or so. If you have, actually, we don't need to look at my picture. Let's look at this instead. If you have any final questions, I would be happy to try to help. So I'm going to peek in chat again. Oh, good. There are some. Someone says, what's your opinion regarding UTMA? So building wealth for children. UTMA, we do have a college plan for them. Okay. UTMA stands for Universal Transfer to Minors account. The answer is, it's not a bad idea, but you said you do have a college plan. By college plan, I think you probably mean a 529 plan. I would fund the 529 plan first. Go ahead and fill that up. The 529 until you think you have enough for their college, because that's a great way to save. A 529 plan, for those who don't know, it functions very much like a Roth IRA in that the money you put in is after tax now. You get no tax break now. But if you use the money for college, any growth or income totally tax free. So if you have children, the best time to start a 529 is the minute they're born. Some people even start them before the kids are born. Okay, good. This person says his wife is already doing it. Good. But um, I'll just say a little bit more about it in case some people don't know. Um, you start the 529 as soon as you can when your kids are born. And then you put in the maximum. The sooner you fund it, the better, because the long-term growth is the whole point. So, if you're thinking, well, maybe we'll put in 5,000 a year for the next 18 years, that's okay. But if you can spare the cash, it'd be better put in a whole lot right now and less later, so that you get to maximize the time factor of that. Um, this person says his wife is already funding 529s. Great. If you maximize those, or you think you've really got enough already for college, then yeah, an UPMA is a fine way to benefit your children. Nothing wrong with it. It has certain advantages. Any other questions from anybody? I'll mention one other thing about, oh, good. I got to thank you. Just one other thing about the 529 plan. In case people aren't aware, this is one of those weird things that changed recently. People used to worry about, well, what if I overfund my 529? What if one of my kids decides not to go to college? What do I do with that money? That's gotten a little bit easier. So one thing is, you can always transfer money from one beneficiary to another. Let's say your oldest child doesn't need all the money you saved for them. No problem. You change the beneficiary to a younger child. You can also change it to their cousin or their sister, change it to yourself, go back to graduate school. But in addition to those options, there's this relatively new rule that says if you've overfunded a 529 at some point in the future, I think you have to wait 15 years, but you can then transfer that 529 money to a Roth IRA for the benefit of that child that you originally set up the plan. So it could be a wonderful gift for your child. If they didn't need all that money for education, you've seeded a Roth IRA for them. It should take some of the sting out of that fear of, did I overfund my 529? It's a great opportunity. Okay. And Elsie has said, put in a thank you note, and she said today's class is recording and it'll be emailed to you within a couple of days. So I'll take that as my cue to say goodbye. I thank you very much to everyone who stuck with us the whole time. I really appreciate your coming, and I wish you a very good career and a very happy retirement. So thank you so much. I'll stop sharing, and if Elsie doesn't tell me otherwise, I'll go ahead and leave.